The last thing that we're going to look at for Chapter 2 is the contribution margin statement format. From now on in managerial accounting, this is the format that we're going to use to show income statements. Let's look at this example where we're selling speakers, and we're selling 400 speakers, and the total sales price of per unit of the speaker is $250. So the total sales is $100,000 for 400 times 250. The next thing that we do in this formatted statement is we subtract variable expenses. So the variable expenses are $150 per unit, and at 500 speakers that would total $60,000. What we calculate here is the contribution margin. It'll be the sales amount minus the variable expenses equals the contribution margin. The last thing that we'll subtract are the fixed expenses to reach our net operating income. Look over here. This ends up being really important information that we've already used. What are the per unit cost, sales price, and variable expenses? Fixed expenses don't have a per unit amount. They're just fixed for the time period. And we can also look at percentages amounts. So the variable expenses represent 60% of the sales amount, and the contribution margin is 40%. The reason why this statement is really important, and we'll end up using it throughout the term, it's very powerful, is that it tells us how much of a contribution margin are we going to generate from our variable after our variable expenses that we can use to cover our fixed expenses. So a really important question that we could answer with that is, what if we needed to calculate how many speakers we would need to sell to break even? And a break even is no profit or no loss. This statement will allow us to do that. Look at how this works. So here's the calculation for break even. We look at our total fixed costs divided by our contribution margin per unit, and that will give us our break-even units. So using the information up here, our total fixed costs are $35,000, and our contribution margin per unit is the $100. If we divide the $35,000 divided by 100, we figure out we need to sell 350 speakers. Now we can test this by actually calculating this out. So 350 speakers times $250 sales price equals $87,500 in sales. Now let's look at the variable costs. 350 times 150 equals $52,500. So our contribution margin at that point would be $35,000. Our sales amount minus our variable costs, and that will just cover our fixed costs and leave us at zero net operating income, which is a break even. So take some time to focus in on how this statement works, and I think you're going to find that that's invaluable for the rest of the term.